Hello, everyone. Welcome to the Stock Specific class here for Thursday, December the 22nd. Sorry about a little bit of a late start. Had an emergency come up and seriously cut into my prep time. I usually just prep an hour before the class, and usually works fine as long as I don't I don't get bugged with anything during that hour. So luckily I've been doing this a long time. I don't usually need a lot of prep. I do a lot of prep all day long, so it shouldn't affect the quality of the class. But before we get started, if you have any questions during the week or any questions I don't get to in the live class, make sure you send those to jerry@traderspro.com. Another quick announcement. Remember that Monday the market is closed. Obviously Christmas is on Sunday, but the observed holiday, they don't get dipped out of their holiday. So Monday the markets will be closed, and just be aware of that. Enjoy it. Extra time off. I always love days of the markets closed because I just like, it's the same reason why I like the weekend. I don't have to worry about anything, any positions I'm in or anything like that. And heaven forbid that we ever get to 24-hour trading 7 days a week in the markets. I think that's when I'll retire, because I do like to be able to have days where you don't have to worry about anything. All right, so and don't be afraid to send me questions for over the weekend. I jump on my computer all the time. If it's probably not on Christmas Day, but Christmas Eve, usually I don't try to go out and compete with the crowds. If I'm sitting at my computer and I see a question, I'll be happy to answer it. All right. I'm going to show you a little bit later in the class why it's very dangerous to be long the market or to start buying stuff in these conditions. I keep talking about, and I'll keep talking about it, the fact that we haven't had a panic sell-off yet in the market, and boy, I tell you, today could be close to jump starting that. We saw the VIX just spike up, and remember that was one of the things I talked about on Tuesday, was that the VIX was going down. The market was going down, and the VIX was going down, and I said, I kept saying that doesn't make any sense based on the context of where we're at. And my argument was this is getting ridiculous, because these are the professional traders we're looking at. The professional traders are not showing any concern that the market's going to drop, and it was obvious to. Well, I don't know. I got to be careful not to. I've been doing this a long time. I see a lot of things that other people don't see just from that experience, but. Man, I tell you, I don't get overly confident very often in the market, but this market is just looking like it still has a lot further to drop, and it could happen at any moment. Maybe it's starting that panic today, but the problem is, and this is what I talk about all the time as a trend trader. This is what you have to live with, is that you can't move the market. You could see things. But you can't move the market. You have to hope the big institutional traders see the same things and react to them, and that's why typically I don't worry about what they're looking at or doing. I just focus on what they're doing. It's just a rare case where it becomes a little bit obvious that they're not reacting yet, and you're seeing it ahead of time, and this is one of them. All right. So we're still in a bear market. We're starting to see now momentum bumped up a little bit yesterday with the rally, but it was in the extreme range. But it's going to move right back in the extreme range when this updates after the market closes, assuming that things hold right here. Again, obviously the market somehow rally into the close. I just don't see it. I can't find a reason. I was trying to find a couple of stocks that I could post as part of the stock specific class, and I will post something that we can keep an eye on. But man, this is a dangerous time to be going long. The breadth indicator, remember, this is one of the things that I was worried about is we had momentum that was in the extreme reversal risk range, but we had the breadth indicator that was in the middle. It still had a ways to go to get to that extreme oversold condition, and that's still the case. It moved a little bit further to the right side of that trending box, but that was, again, that's not taking into account today. It'll update after the market closes, and we'll probably see this thing move into probably this area right into here, meaning that there still could be more selling from a breadth standpoint. And what that means is that right now the market, what this is telling me is that the market is dropping. So that's why we're seeing the momentum is getting to that extreme reversal risk area quickly. But the breadth indicator is saying right now, it's saying there's not a lot, at least as of yesterday, there weren't a lot of stocks that were leading that move down. So, there was a group of stocks that were causing the markets to sell off, but there were a lot of them that were holding up. And that makes sense because if you go look at the Dow Industrials, there's a lot of the Dow stocks, the 30 Dow stocks that look pretty bullish, that still look pretty good, that didn't really sell off a lot on this initial move down. And so what we're seeing today is now there's a lot more stocks that are selling off. There's red all over the place. So, and so now we're seeing there's more participation in that selling. And that's what we need to see a panic sell-off. When there's a panic sell-off, everyone just hits the sell button. It could be the best fundamental company on the planet, and they're going to sell it because they're in a panic. They don't know what to do. They just see red everywhere. And again, we're not there yet, believe it or not. We're not even in the fear range yet. But that's what you tend to see. And I hope everyone gets to experience it. I hope it happens so everyone can experience it. So you know exactly what I'm talking about. You can use it as a frame of reference later on and say, hey, when somebody says it's panic selling, you're like, dude, this is not panic selling. I know what panic selling is. I experienced it back in 2022 or 2023, whenever it happens. And you'll be able to draw on that later on. All right, so, and then this is the scary thing is sentiment is still, now this will move down, should move back a little bit with the spiking of the VIX a little bit today, but it's still not reflecting that concern yet. And believe it or not, I'm telling you, this will move when that market becomes fearful. Just to show you though, you can see visually, it'll need to get below this red. Well, if it gets below this red button, it'll get out of that extreme range. So it would actually finally move out of this extreme complacency range. But we should see it back off a little bit with today's selling. Again, assuming that things hold up the way they are, we should see that take place. Now, as far as the buy-sell ratios, we talked about this on Tuesday that we were getting a little extreme. And they were, we were starting to come a little bit closer together. Again, this is as of yesterday with the buying. They started to come a little bit closer together. We'll see these spike back out again. Again, assuming the market holds the sell-off today. Now it is telling us we're getting stretched a little bit. Now we can become more stretched. Some of these sell-offs became even more stretched. And keep in mind, if this sell-off, and again, I don't know if it will be, but if it is bigger than the other ones, if it does create that panic, get the VIX spiking above 40, we could see the buy-sell ratio get really wide. It could get extremely wide there on that move. So this is telling us it's stretched, meaning it did that. And by the way, that's why yesterday's rally it didn't surprise me at all. The market was getting a little bit oversold in the near term. You don't usually see a straight move down. And even when I talk about panic sellouts, I'm not saying that you can't have a snapback day or two where short covering and buying does take place, people trying to buy the bottom. That happens all the time. And so when the rubber band gets stretched, you can snap back a little bit for a day or two. So yesterday, it wasn't shocking that it rallied. In fact, I think I talked about this on Tuesday, that we could see a little bit of a bounce or attempted rally. And really, that's what it looked like yesterday. It snapped up a little bit, and then you saw it fade a little bit in the close. It wasn't a real strong close. And then we rolled over today. So, by the way, the rally yesterday, and considering that we're in that a little bit of a near-term oversold condition, I was tempted to get out of a couple of one or two of those inverse ETFs. In fact, I talked about it on Tuesday that I was going to make a decision at the end of the day, and the more I thought about it, and I had the gold stock is kind of my bullish trade. I figured I'd go ahead and hold on to those, and they're really paying off today. So we'll see when we go to the portfolio. I'm going to plan on holding on those for a little bit longer. All right, so and then the sentiment indicator again was getting down here, a little bit oversold. We bounced a little bit yesterday. It'll come back down close to that oversold range probably on the sell. Now, there again, if all these things hold, we should be very close to an oversold condition. And that means that a snapback could happen at any time. In this context, though, when you're in a bear market, you're in this downtrend, you don't really want to just start buying stuff in that context, because any rally is probably just still a rally within the downtrend. Now that'll change, and when we transition back into a bull market, you'll see what I'm talking about. That's why we look at the trend of things, because when you're in a clear uptrend, you flip everything upside down. You buy the dips, you buy the pullbacks, or you look at those pullbacks as buying opportunities. Whereas in the downtrend, you realize that the rallies are rallies within the downtrend typically, and so you usually try to avoid buying into those. All right, get into our charts. Okay, hold on here. Get rid of the volume bars here. We can see things a little bit better. All right, so you can see this is what I was talking about yesterday. Well, so we had Tuesday. We were talking about a little bit of an indecision day. We opened a little bit lower. It looked like we were going to close higher than where we opened. Now, what I'd said on Tuesday was if we closed at the highs of the day, that's where I might have considered getting out of some of those inverse ETFs. But again, we faded into the end of the day, but we did end up moving higher the next day. Same thing yesterday. I was like, I wonder should I go ahead and take some of those off, and then I decided to hold them, and then we had this big move down. So, but this is, when you get a move down like that, you should get a little bit of a bounce, and it could have. I'm putting it. What also complicated things too is from experience that the couple days before Christmas through the end of the year is typically a bullish time of the year. Now, having said that, I've been through a lot of these. I've heard the Santa Claus rally. That's why I think it's so ridiculous, because everyone changes the Santa Claus rally time period. But I've traded so many of these, and I can't tell you how many times I just kind of this is earlier in my trading career, just kind of blindly bought stuff during the days before Christmas through the end of the year, because everyone talked about how bullish that time of the year is. And I can't tell you how many times I lost money when the market would go up one day, but it'd go down a couple of days, and everyone would point to the up day as being, hey, there's the rally, there's the bullish day right there, and then you'd lose the money the next day or something when it moved down a little bit. There's a lot of sideways movements, or there were a lot of times where there was the market indexes moved up or down or up, typically in the bullish time of the year, but in a lot of individual stocks, there were few stocks that were making those moves, so the breadth wasn't great. And I just happened to be in the wrong stocks. All my stocks went down, and the other stocks went up. So, just the bottom line is the only time you're ever going to use sentiment indicators, or not sentiment indicators, but what's the word I'm thinking of? The time period indicators, meaning this tends to be a bullish time. This tends to be a bearish time. The only way you're going to use that information is as additional confirmation to the chart pattern and indicators you're already looking at. So seasonality is what I was thinking of. So if I have a bunch of bullish looking trades and I know I'm in a period of bullish seasonality, then that can be an additional confirming factor or give me a little bit more confidence in my trade. But it should never be the starting reason for the trade. Oh, this tends to be a bullish time, I better be looking to buy something. Because I'm telling you, there's not a lot of anything that looks like I want to buy right now. And I don't care, what time of the year it is and whether you're saying it's bullish or bearish. All right, so by the way, there's another thing I wanted to point out here that it's a real subtle thing I look at or I use to, it's a very short-term bullish bearish bias thing that you can use, and it's really simple to implement. Now, you know that you've heard me talk about inside days before, outside days, candle formations. Let me show you one recently on, was it Pfizer? Yep, Pfizer. This was a bearish inside day where you had this big run up and you had a big bullish candle right here. And then the next day, you had the opposite. You had a bearish candle. It opened up here, it closed down here, and the entire body of that candle was inside of the candle of the day before, and it's in the opposite direction. That's key. You got to have it in the opposite direction. This was an up day. This is a down day. And it was usually you want a big run up ahead of that. This is a bearish formation. You almost always get some sort of downward move off of that. We got a big downward move that next day off of it. You don't always get that big of a move. But it is what we call a bearish reversal candle. It's one you need to learn because whenever you see it, like I said, it gives you a high probability of direction. It's very short term, meaning it doesn't mean you're going to start a new downtrend. It can just mean you move down the next day and then go right back up again. So you don't want to put too large of an emphasis on it. But there's another simplified approach that you can use where you look at the extreme range. So since then, so the next day right here, you can see you had an intraday high up here, an intraday low right here. What I often will do, I do it just in my mind, but if you were to draw a line across that, what you want to see is, do you close outside of that range the next day? If you close above the range the next day, that's more bullish. That means the buyers were able to push prices outside of that range for the day. If it drops below the close, I'm looking for closing prices, and sometimes you're going to have to make judgment calls because it could be right at the line. But if it closes below, well, even then it's still showing indecision in my opinion because it didn't clearly break out of that range. If it closed below that range the next day, that means the sellers or the bears are a little bit more in control. Now, these are real subtle clues, so you're not going to make your entire trade decision on this. but I do use this as a confirmation entry technique. I talk about that in a close above the high of the previous day or a close below low of the previous day as a confirmation for decision for entering trades. A lot of times I'll use that. But so if you look at this context here, so the next day, what happened? The price action was inside of that range. So I don't want to make any strong decision out of that. It could still go either way. Now you could put emphasis on the fact that you had an impulsive move down, so it's probably more likely to break below that range. You could make that argument. But on that next day, it didn't do anything, and so I don't want to assume the bulls or the bears are winning. In fact, just the opposite. It's telling me that there's a standoff. Neither one is winning. Then you look at the range of this day right here, and we did close above that range. So it did tell you that the buyers were showing a little bit more strength that day. But again, you've got an intraday high up here, intraday low down here. You've got a really small body right there. That's not a real strong confirmation that the buyers were in control. So I'd be very cautious, especially after this big move down right here. Then you take, so today, what is today telling me? Well, you got this range here, you got this range here, and we're below that range. So it's telling me the sellers are a little bit more in control. When I was off the lows of the day, though, I'd want to see a clear close below that low, and I'd love to see it close at the lows of the day to tell me that the sellers were a little bit stronger there. So this is just a real simple technique, and it's kind of based on the inside-outside day approach, but in this approach, you want the entire body to be inside of the body of the previous day, and in the opposite direction. It's a different way of using it. This is just looking at just a kind of a momentum check. Are buyers or sellers in control? Now, again, you don't want to base your entire decision on this, but if you're looking for, if you have a bullish looking pattern, I have a bullish ABC pattern, and I'm looking for that confirmation, to get in, and you have a couple days where you're not moving outside of that range of the day before, and then you get a clear close above the high of the previous day. That could be a good confirmation entry that the timing to get in is good at that point, because you have the bullish pattern, you have the bullish trend, and you have the near term bullish price action of the buyers telling you that they're taking control, at least in the near term. Again, none of these things are going to make it absolute. Doesn't mean you're always going to be right. You're still going to have trades that get stopped out, but these are just little subtle things that you can learn to help you kind of analyze some of the stuff, especially when I start talking a lot about price action and things like that. Okay, I'm getting a comment here. Is there still a problem with the audio? Are people having problems with the audio still? I can't hear anything on my end, so I hear there's a couple of people that said they're hearing clicking. If I can confirm that's still a problem, what I'll do is I'll dial back in. I'll hang up and dial back in. But somebody give me some confirmation that they're still hearing clicking. Because if it's gone, I don't want to waste time to dial back in. But is anyone still here? I'll wait here to see if somebody can type me a. Okay, here we go. All right, there's noise. All right, I'm going to dial back in. So let's just pause here for a second. Let me dial back in. See if that fixes the problem. Can everyone hear me better now? I just dialed back in. Is it still clicking? Someone can type me a response and let me know before I get going again. If it's still going on, I don't know what else I could do. Like I said, I can't hear it, and then I don't know how to fix it. Okay. All right. So we're good. All right. Thanks for letting me know. Sorry that a lot of times I won't check the questions until I'm done with a thought, because it can, if I always look at the questions and answer the questions immediately, it affects the flow of the class. So I appreciate for letting me know, and sorry that it took me so long to see it. All right, let's keep going here. Should I turn the video back on? All right, so that's just something that you can use. Like I said, I wasn't really planning on going into that, but it's something that I do use, and sometimes I don't always. That's part of the problem with teaching and just things in general. There's so many things that you learn over the years. You can't possibly tell everyone everything you know, but you get into situations where you see something, and that's kind of the benefit of having the class. Sometimes these classes are repetitive, but sometimes they draw out little things that I've learned over the years that I can share with you that'll speed up your learning curve, but that you don't necessarily think to add to a curriculum of a class or anything like that. So, all right. Now, it looks like we're off the lows a little bit. We'll have to see. Now, it's not too shocking. We're kind of coming out of the lunch period in the markets, and during that lunchtime period, the markets can kind of go back and forth. What I really want to see is how we close today, and do we close at the lows of the day? That'll be something that we'll definitely be keeping an eye on. All right, so I'm not going to spend too much time on the other charts because they're basically showing us the same thing. Although I will point out on the Qs, you can notice the Qs aren't that far away from that October low. We're getting real close to it. And I think this is important because you remember what I keep talking about, or what I talked about a lot in previous classes, was it's clear that on this latest rally that the Dow was leading the way. That was clearly an impulsive looking move up through here. The problem is that the Dow usually doesn't lead. It usually follows. And so it made me very suspicious of that move. I think now we're seeing that play out. The NASDAQ usually is the one that leads, and I think it's leading the way down. And not to say that the Dow necessarily has to break that October low, but it does show that there's potential there for the Dow to really get hammered. And some of the valuations of those Dow stocks are getting pretty high and may need to come down quite a bit. So that's something to keep an eye on. So, all right, Russell 2000. Let's go into the bond market. I told you this on Tuesday. We had this gap down on Tuesday. I said this area is important. It could still be a bullish ABC pattern here, but it really needs to start to move up from here. We've kind of been sideways, which is actually showing that maybe there's more likely to have another move down. 3 days though, it could still start moving up, but it would have to start moving up here pretty quick. So tomorrow could be a key day as far as the uptrend in bonds. Is this just a correction within the uptrend, or are we rolling over and going to have a more significant move down? Gold had a bigger move down today. I'm still holding my gold stock. I'll talk about that when I get to the portfolio. It's not at my stop loss area yet, and I still think that gold is ultimately going to be trending up. But that is a pretty significant move down. But we had one back here as well that rebounded. So we're kind of testing a support area right through here. This is a breakout area. This is a key low right here. If it drops below that breakout area and below this low, then you have to start to look at the possibility that it's a bigger correction, or maybe it's going to come down a little bit low. Maybe it comes down and retest this breakout area. You also have a trend line right up through here. It's not going to be a straight line. See if I can draw a straight line. Yeah, that's close enough. So you see, if it starts to breaks below here, you have to start to see that as more bearish at that point. Although not necessarily saying it's got to resume this larger downtrend it was in, but just could mean that it's in a bigger correction. That's something to keep an eye on there. It's kind of at a critical spot. Oil, this again, I talked about on Tuesday how I was a little bit concerned with the way this was shaping out, that maybe this was a bearish ABC pattern. And then we get this bearish. Now, this is an outside day right here. We call this a bearish engulfing pattern, where you had this little move up. You had here's the body of the day before, and then you have the opposite body, but it engulfs the candle the day before. It opened up here. It looks like it could close down here. You need to base this off of the market close, though. So I don't know if it rallies off the lows quite a bit, it could change that. But as of right now, that's a bearish engulfing pattern, or an outside day, if you want to simplify it, just call it an outside day. The fact that it's showing up at what could be a wave C of a possible bearish ABC pattern would cause me to be more bearish on oil, and it kind of would confirm my worries last Tuesday. Remember, I was bullish on oil last week. This is what's caused me to be more bearish again, flip-flopping again. And this is an illustration of how, I used to have a phrase where I used to say flip-flopping in politics is deadly, but flip-flopping in trading is absolutely necessary. You got to be a flip-flopper. And in normal context, people don't like flip-floppers, right? You have a friend that's a flip-flopper, you don't like that friend very much, right? But in trading, you have to be a flip-flopper. And as strong as I could come across as being bullish, I was never really strongly bullish on oil back in here. In fact, I said this was looking a little bit more impulsive off the bottom. You had impulsive down, impulsive up. But I always keyed in on this area is you got to get above that high. We had a lower high, lower low. You got to get above that high to really turn more bullish on oil. And we haven't done that. It looks like we may not do that soon here. It looks like we're probably heading lower. But again, what is the chart telling you? Don't be afraid. You don't want to be worried about being right or bragging about your big call that you made. You want to make sure that you're reading the trend properly. And if it's showing right now, it's showing heavy signs of going lower. Again, it doesn't mean it will, but with everything in the context here, you got impulsive down. This looks like a bearish ABC pattern, bearish engulfing pattern. And I've got to lean towards oil going lower, at least in the near term. Within the next few days, I would expect that trend to continue down. You could also draw, if you wanted to add to this, you could draw a trend line declining down right here. And it seems to be reacting to that as well. You could draw a support area right through here that it seems to be having trouble getting above. You could do what I told you earlier. You could take the high and the low of the day before, and if we close below that, the bears are in control, or at least showing strength. All right. Well, and but keep in mind too, if you're doing this on a day-to-day basis, I mean, look at yesterday. Yesterday, if you took the range of the day before, we clearly closed above that range. Okay. So yeah, the buyers were showing that they managed to break it out of that range. You got to be able to flip flop the next day though. If the bears put you right back below that, and again, I'm not saying that you have to make a decision off of that, but it helps in your decision-making process. So I use this a lot in option trading, because option trading, you have to be nimble. You have to be I could be in a trade, and then the next day it's like, oh, this is not looking good. I have an expiration date. I better get out. I jump in and out of things all the time, and so I need a quicker signal of that shift from bullish to bearish. All right. The dollar is rallying a little bit here, but we're still in the downtrend overall. So we're still, this is still just looking like a rally within the downtrend. I'm still a little bit more bearish on the dollar. And then the VIX, you can see the bigger spike on the VIX today. Although let's go into, so we're off the highs a little bit off of the VIX indicator. And that makes sense that the market is rallying a little bit off those lows. Let me just double check my SPYs. Yeah. Now, again, this is what over the last couple of days, this is what didn't make a lot of sense, especially yesterday. Yesterday, we're moving back below. We've actually moved below 20. We haven't really dropped that much in the context of everything, and we're back below 20 again, where the market tends to sell off. To me, it was just saying no one's seeing it yet. No one's expecting this drop yet. Or, like I said on Tuesday, one of the things I theorized was that these professional traders were trying to hold out to the end of the month. Maybe they know they need to buy that protection, but they're hoping not to spend that money before the end of the year to buy it, hoping the market holds up just because of the bullish seasonality, and that could make it pretty ugly right after the new year if that's the case. But they may not have a choice, and I think that's why we saw it spike pretty good today. Was they're making plans to go away for the holidays, and then suddenly they've got to deal with the selling today, and they're being forced to buy those protected puts, which is causing the VIX to spike up a little bit. So we'll keep an eye on that. Again, it's going to be important at the close to see how everything closes today. If we close off at the lows of the day, there's still a chance we can bounce again, like yesterday. It's just I don't think it's gonna take us anywhere. I don't expect this big market rally to take place out of that. So chip stocks, they're really showing a big move down. And we have the SOXS in our portfolio, meaning as this goes down, ours is going up. Transports, Bitcoin's just been so sideways. But it still looks like it's in a downtrend there. All right. Let's get to the portfolio here, because like I said, I don't really have a whole lot of new trades to be getting into. We're up to 142 now. We've just been sluggish. We were 137, 138, 139. We hit 140, then back down to 139. We're just trying to grind away some profits here. We don't have most of our portfolios in cash. The biggest thing I'm trying to do is not lose a lot of this money during this period of time. The safest thing to do is just, like I said, be in cash. But I'm trying to do something for those of you that want to do something. But hopefully you're seeing this, and just because you have the money in your account doesn't mean you want to be using it right now. If you're smart enough and disciplined enough, it'll pay off big time for you. Because when we do bottom and we do start a new bull market, you're getting into the new uptrends on these stocks, as opposed to getting in at the top and having the pain of losses and losing money before that happens. So just be smart, be patient. It will pay off if you can just kind of wait it out. NEM, I told you I still am hanging on to. Not down too much today. Actually held up pretty well. Remember, gold had a pretty bigger move down, but I'm pretty sure I have my stop down below here. Let me double check that. Where's my stop? I think I wanted to give this plenty of room. 37.40. Yeah, that's below down here. So I'm looking at this kind of a bowl-shaped move. Now I do need to keep an eye on this low and this low. We start breaking below those lows, and you get a little bit concerned that you're reaching some lower lows, and that maybe you'll start trending down a little bit. But so far, I'm willing just to let that kind of go right now. And then the other, this SOXS, this is going to go up when the chip stocks go down. Again, I was a little concerned yesterday. It started to move down a little bit, but back up today, this looks more of a bullish pattern right here, which means there's probably more selling on the chip stocks. And that I'm going to continue to hold that for now. The only thing, by the way, the only exception to this is if something happens in this last hour and the market starts rallying very strong into the close, I might at least, maybe not get out of all those inverse ETFs, but I might lighten up a little bit just in case there is some sort of reversal. I'm not expecting that, but you never know. All right, SARK, big move up today. Now you are bumping into a little bit of resistance here. You are getting into that extreme reversal risk area, and then the right side of that extreme reversal risk. And so that, if we got kind of a kind of an ugly sell-off day, this would be one that maybe I'd start taking some profits on, or go ahead and get out, or tighten up a stop on it. I can move a stop up to right up. Well, I think I do have it. Where is my stop on this one? 55. Wow, that's way down here. Let's move our stop up. I'm going to move it up to right in here. Let me see what the high of that day was. Get it below it. High of that day was 63.32. Let's just say 63. We'll put our stop, raise our stop to 63. This has been a good trade. We're at 68. We got in at 60. That's what I'm talking about. That's how you're making money when the market's going down. We're making money on these going up when the market goes down. Yeah, SOXS, we're up $10 on that one. Let me see where my stop is. 26 on that one. Let me see where. Yeah, shoot. I don't know where to. I'm going to wait. I don't know where to move it from here. Really, I could move it up into this area right here, but I'm not going to move it up on that one. And SPXS. Again, this looks like it's still, just to get to those October lows in the S&P, it could get all the way up here. I think my stop's down below here. We could probably move it up to this area here. Get it below that. So let's just say about 20. Let's say about $20. So we're not moving up very much, but we'll move up a little bit there. All right, I want to show you something though. Let's look at because I talked about adding possibly some coal stocks. I wanted to add a CEIX, but I was going to hold off on it. Let me just show you why it's dangerous to buy anything right now. Yesterday, actually Tuesday, it looked pretty bullish. I was really tempted to get in, but I was a little bit worried about market conditions. The market moved up yesterday, and I was tempted to get in again because I just like the pattern here. But I again, it's just it still looked like the market could sell off at any moment, so I held off, and then you get this big down day right here. So you have that happen where you almost just walked into a losing trade, and it just reminds you to continue to be very cautious about buying anything in this environment, even if some of these patterns look pretty good. And that's why I worry a little bit about. I know that the name of the class is a stock specific class. We're looking for trades, but normally I don't have such a. I don't warn people so much to be cautious. In normal bull market conditions, I'm saying, yeah, let's look at these and get into some of these trades. But you do want to be really, really cautious. I would easily recommend some of those inverse ETFs. So if the market continues to go down, those should outperform and do pretty well. And those would be the safest ones to be in right now, in my opinion. Another one, though, too, that was on this list, ATI. Yeah, that looked like a nice little bullish move. Looked pretty bullish those last couple of days right there, and then bam, bearish candle right there. Now again, it's not too devastating. It can still hold this thing right here. In fact, what you'd look for is it's currently still trading above the low of yesterday. So if it closes in that area, it's still inside of yesterday's range. I'd say, okay, get additional confirmation. Wait for it to see if it can break out above here, and then hopefully the market is rallying up at that point. But I do like some of the stocks in the sector, basic materials, in this case steel stocks and things like that. They're looking like they're starting to make a move. Halliburton was one down here. I was liking the way it was forming, and then this bearish candle today. And again, it's trading out below the range of yesterday, so the bears are a little bit more in control. And remember, my view of oil and the chart of oil looks like it could drop. I'd stay away from this one for at least a little bit until oil starts looking more bullish. So is there any other ones that look okay? Well, I did like this ADLX right here. I like a lot of the biotech medical stocks. But this one is a pattern I like to see, kind of that bowl-shaped pattern where it looks like you're moving up the right side of the bowl, a little bit of a correction right here. Again, you could wait for a breakout of that range as additional confirmation. Let me switch this over to signals here. You can see it's had a buy signal for a little while, went to hold and then back to buy again. And if you look at just the general healthcare or biotech sector, the IBB is the ETF for the biotech stocks. It kind of has a sell signal right now, but hold and sell signal in that range there. But I like the kind of cup with handle formation that it's formed. It can break back above here and be very, very bullish. It'll probably go back to a buy signal somewhere in this range. So if you just wait for it to go back to a buy signal, you can do that. But this would be just trading the whole group. But I like that pattern there. I'd keep an eye on it. It's just something to pay attention to. Now, if you're going to trade biotech or medical stocks, be ready for a roller coaster ride. Don't put a lot of your money in it. You could have a stock that goes from $80 to $40 overnight because there was a problem with their drug, or their drug that they had such high hopes for didn't get approved by the FDA or something like that, um, or they find out that the drug causes serious health issues they didn't know about. They're probably going to have a bunch of lawsuits on their hands. These are not, you don't want to have a lot of money in biotech stocks. But on the other hand, too, they can go from a $20 stock to 60 overnight because their tests were positive of the new cancer drug or something they have that the world's going to need. And but it can be a little bit of a roller coaster ride. Question: what are inverse ETFs? Inverse ETFs are they're designed to go up when a market or a stock goes down, or usually it's an index. I don't know of any. Well, there might be some inverse ETFs on the individual stocks now. There's a lot of weird things that are coming out. They just wouldn't have a lot of liquidity, so I wouldn't trade them. But I have a watch list that I throw a few of these in. Some of these are not great trading instruments. I don't like the SH, and the reason for that is this is opposite of the S&P 500 index, and the reason for that is you're not going to make any money if the S&P goes all the way back goes down to the October lows. This goes all the way up to the October highs. Look how much money you're making. It goes from 16 to 17. You made $1.50. What I like instead is the SOXS, which is the opposite of the SMH, which is the chip stocks ETF. And if this goes back to if the chip stocks go down to their October lows, and this goes up to the October highs, it's going from $35 up to $85. Okay, I can see where I can make some money on that. Make a lot of money on that. So, and again, we're using these for is a way to make some money when markets go down, because markets fall a lot faster than they rise. If you don't know what you're doing, just sit in cash. Don't do anything. But if you want to try to make a little bit of money and not have to short stocks, because shorting stocks is a whole different type of trading, and it can be dangerous and it can be very costly if you don't know what you're doing. You can have unlimited risk. You can have margin calls, and your broker forcing you to buy back the shares and use up all your money to do it in your account. He can force it. So the safest way is to use these inverse ETFs, where basically they're shorting the stocks in their ETF, but it's designed to where you can be long it. You can just buy it, and it'll go up when these things go down in value, when these indexes go down in value. Some of the more popular ones, most of the ones I use are the SOXS and the SARK. SARK is it short the ARK Innovation Fund, ARKK, which is Cathie Wood's ETF. It's been going down, and it's been really getting beat up because she has a lot of these innovation tech companies that she owns that she's expecting to turn around. They keep going down in value. It's funny because she was hailed as being one of the smartest people back here in 2020 when she got into a lot of these things. We can't even go back that far. And then she just continued to hold on to them. And this is why you got to be a trend trader. If the trend is down and these things are down, you get out of them. You don't just dig in. And she's so concerned with being right and want to tell everyone that she's right that she's ridden these things into the ground. And it makes no sense at all. I would never follow her. I've heard she's smart, but this is not smart behavior. This reeks of someone that just wants to be able to brag in the end of how smart they are. And maybe 10 years from now, if these things don't go bankrupt, these stocks she's in, and they can go back up in value, maybe 10 years from now, she could brag about it and say, see, I was right. But man, that's expensive and kind of idiotic way to want to brag, to tell everyone how right you are. So I do the opposite. I'm in the fund that's going to go up when her fund goes down. So yeah, you can use these. I'll leave this on the screen a little bit here if you want to write down some of those ticker symbols. It'll be in the recording as well if you go to the YouTube channel, and you can view the recording and pause it and everything. And like I said, I don't like some of these. These are fairly popular index ones. The SH is not good. DOG is not the greatest. What I like are some of the the leveraged inverse ETFs. Those tend to work a little bit better. The ultra short. But they're very temporary. You don't want to be holding on those for a long time. They're meant to be very short-term trades. I only jump into these when I think the market's going to drop, just to see if I can make a little bit of money while it drops. So, and I manage them differently. I'm not looking at the signals or the strength rank or anything like that. These are just purely going off of chart analysis and chart behavior, and usually it's based off of my analysis of the indexes. The indexes look like they're going to drop. Okay, let's jump into these to try to make some money on that drop. All right, all I have. I wish I had better Christmas presents going into the weekend here for you, but I guess maybe the inverse ETFs could be that. If we continue to drop, they should do pretty well. Now we're off the lows a decent amount. We'll have to see how things close today. Now it'll be usually right about now is when the professional traders, they usually close the market, and so I don't. It doesn't really bother me that we're off the lows of the day. I'm short a lot of stuff, by the way, or I have put options on a lot of stuff, so that's why I'm glad the market's down. Hope it goes down further. That's how I'm going to make money if it goes down. But I'm not too worried that we're off the lows of the day, just because a lot of times that'll happen and the professionals step in at the end of the day and they'll close it. But if it's like that at the end of the day, that's showing a little bit of indecision going into the close, and it could reflect some of that bullish seasonality again that may hold the market up a little bit over the next week or so. Could be possible it does that. All right, thanks everyone. Have a great week. We'll see. We'll have class on Tuesday and Thursday next week, so be ready for that. If you can attend it, great. If not, you're spending time on holiday, that's good too. Not a lot's going to be happening. There's going to be very low volume. Not a lot. Shouldn't be a lot going on. Who knows though? Maybe that's when the panic kicks in. But we'll see. Have a great weekend, everyone. Have a very Merry Christmas, very happy holiday, or whatever you celebrate this time of year. Have fun doing it, and we'll see you back here on Tuesday for the market update class. Bye now.